Good morning. What is a Delaware Statutory Trust, or DST, and how is it used by real estate investors? Well, a Delaware Statutory Trust, DST, is a legal ownership structure that allows multiple investors to hold beneficial interests in an institutional grade real estate project while still qualifying as like kind property under Section 1031 Code of the IRS. And for real estate investors who want to defer capital gains taxes, reduce active management responsibilities, and maintain exposure to stabilized assets. DSTs have become one of the most powerful and misunderstood tools in the 1031 exchange landscape. And as mortgage brokers and capital advisors, we frequently help investors evaluate when a DST makes sense versus traditional direct ownership, especially during tight timelines or market transitions. And how a DST works. A DST owns one or more income producing properties, such as multifamily communities, industrial and logistics facilities, medical office buildings, net leased retail, institutional mixed use assets. Instead of owning real estate directly, investors purchase beneficial interests in the trusts. And these interests are treated as real property for 1031 purposes, which allows investors to sell a relinquished property, to defer capital gains and depreciation recapture, to reinvest proceeds into a DST within their IRS timelines. And each DST is professionally managed and structured with non recourse financing already in place. So, why do real estate investors use DSTs? Well, DSTs are commonly used by investors who want some of the following. Number one being 1031 exchange compliance. So DST interests qualify as like kind replacement property under IRS guidance. And there's passive ownership. So there's no tenants, no toilets, or midnight calls. And asset management is handled by institutional sponsors. There's also fractional ownership. So you can invest in large properties with smaller allocations, often starting around $100,000. There's portfolio diversification, spread exchange proceeds across multiple assets types as well as markets and or sponsors. And there's predictable cash flows. Many DST offer stable monthly or quarterly income distributions. So how about DSTs and financings? What do investors need to know with regard to that? Well, one of the most important advantages of DSTs is its pre-structured financing. Loans are non-recourse, and interest rates and terms are locked in. Investors are not personally liable, which is a big selling point for a lot of folks. And there's no underwriting of an individual investor. And from a mortgage advisory standpoint, this is critical for investors who are wanting to avoid having to qualify for a new loan by themselves, or are retiring or reducing their active involvement in real estate but want to maintain in the game, or existing highly leveraged properties, or if people need certainty during a 1031 timeline. And DSTs remove financing risk from the exchange process. So when does a DST make sense? DSTs are particularly effective when a 1031 exchange deadline is approaching and you need to dump your money into somewhere so you don't have to pay tax on the whole basis, or the investor wants passive income, or replacement properties are overpriced or scarce, or the investor is downsizing management responsibilities. And estate planning and succession are also priorities for some of these folks. Now, they are also commonly used as a temporary or permanent solution, and some investors later exchange out of DSTs into direct ownership when markets shift. And what are some potential trade offs to understand? Well, DSTs are not for everyone, and key considerations include limited control over operations, illiquidity during the holding period. There's fixed business plans set by the sponsor. There's also suitability requirements for investors. And this is why DSTs should be evaluated as part of a broader capital strategy and not as a standalone product. Well, how does medallion funds help investors use DSTs strategically? Well, in medallion funds, we don't sell products, we structure outcomes. So that means we help investors and advise investors on coordinating DSTs within 1031 exchanges or comparing DSTs versus direct acquisitions, as well as evaluating sponsor quality and debt terms, and also to see if it aligns passive strategies with their long term goals. And that could be the point where we integrate DSTs into broader real estate and lending plans. Now, the right DST can protect equity, preserve income, and buy time when used intentionally. And here's the final thought on a Delaware Statutory Trust. It's not about giving up control, it's about strategic flexibility. So, for investors navigating tax exposure, market volatility, or a life transition, DSTs remain one of the most effective tools available when paired with the right capital advisor. My name is Bill Rapp. I am a capital advisor. You can reach me on my website, billrapponline.com, and schedule a consultation, and we can chat more. Thank you for your time.